In this video, we're going to be considering the legal, regulatory, and tax aspects of bond issuance, but also bond investing. So let's start with legal and regulatory. I'm going to try and tackle these on one side and leave tax considerations for the other side. When bonds are issued, when fixed income securities are issued, most of the time they take the form of what's known as domestic bonds. Now, domestic bonds are bonds issued. I probably didn't need to write bonds issued because it's domestic bonds issued by those issuers who are incorporated, so registered from a corporate point of view, in the country of issue. So you issue the bond in the same country in which you yourself are registered. And that's the sort of the most common, obvious thing to do. However, what we also have is foreign bonds. This is when the bonds are issued obviously in a foreign market. So issued by issuers, that's quite obvious, incorporated in a foreign country, in a foreign jurisdiction. And why would you potentially do this? Well, there are some motivations for this given by your book. It could be because your domestic market is not big enough. It's underdeveloped, right? Developed, you wouldn't have access to the same investor base in your domestic market. Or maybe it's because you want to match the currency of the issue with funding needs. So maybe you're a European company, but you issue a Japanese yen denominated bond, which is issued in Japan and addressed to Japanese investors because you need Japanese yen for some investment you plan to make over there. Or maybe just so as to attract a broader investor base and geographically diversify your investors a bit. Right. The third type, which is very specific, is something called Euro bonds. Now, Euro bonds are issued outside of the jurisdiction of any single country. Of any single country. So it's not, one of the European countries, it's outside of the jurisdiction of any single country. And you need to know some of the features here. They may be denominated literally in any currency. It doesn't have to be the euro. The name is therefore a bit misleading, isn't it? They may be denominated in any currency. They are also typically unsecured, so there's no collateral involved. What else? They are typically, once again, underwritten. That means sold by banks, because whenever a company wants to issue bonds, be it these ones, or these ones, you typically hire some banks acting in the capacity of investment banks to help you find investors and sell the issue. And this is the formal word for this is underwriting. So they're going to be underwritten by banks from various countries, typically, of various jurisdictions. And one thing that your book talks about, I'm not really sure why, is that in the past, I'm going to write it down. In the past, these bonds took the form of bearer bonds. Bearer bonds means whoever currently holds the bond is entitled to receive the inflows associated with it, like the coupons or par value, but there is no record held anywhere of who currently owns the bonds. Now, these days, that's no longer the case. These days, most securities in most jurisdictions, well, pretty much everywhere around the world, takes the form of registered instruments. So they are registered bonds these days. In the past, they were bearer bonds. So you might get a question about this. No record in the past held of who the owners are. But I guess you can see how potentially that would lead to problems with things like money laundering, potentially. These days, registered bonds, absolutely. So ownership is recorded and records are kept at all times and updated. Right, and the final type you just need to know about is something called global bonds. Let me try and fit this in here. Global bonds. All right. You literally do need to know what the differences are, because this is very good material for a potential theoretical question on this topic. So global bonds are issued simultaneously in the euro bond market, but additionally to this, at least in one specific domestic market as well. So they're a bit of a combination of what we've already seen. However, I have to stress, because your book talks about it, or your curriculum talks about it, that where a bond is issued, how it is registered, is really less important to another consideration, and that's the currency in which the bond is denominated, because most of the value changes that affect a bond are going to arise from factors relating to, well, on the one hand, the financial condition of the issuer. That's always very important, but also what's happening to interest rates in a given currency. And as interest rates go up and down, the price of bonds, especially fixed coupon bonds, will fluctuate. So that really is the biggest driver of bond price behavior, that fluctuation in interest rates, which is currency specific and not jurisdiction specific, and obviously considerations concerning the quality and the financial condition of the issuer. Right. So as I said before, I want to utilize the space over here for these tax considerations. And, your book doesn't go into a lot of tax considerations because they are so country specific. It would be difficult to create some universal rules here. So what they say is taxability of gains is jurisdiction specific. Yeah. And it varies by jurisdiction. What happens sometimes is that capital gains or short-term capital gains. Now, let me explain. A capital gain is a gain arising from the fact that you bought something at a certain price and then the price went up and you sold the asset for a higher price. That's a capital gain, as opposed to income being generated by an asset like interest or a dividend. Capital gain is the price appreciation. Now, capital gains, if they are generated over a short period of time, which is, you bought today, 1 week later you sold. Well, that's, in many markets treated as speculation, and speculation is not necessarily incentivized. So what may happen is the tax rate you will face on your capital gains, if they are the result of short-term trades in the market, the tax rate on these may actually be higher than if you were to achieve a capital gain, but on a longer term holding. Now, obviously, what's short term versus long term is going to be very jurisdiction specific, and this differentiation doesn't necessarily exist everywhere, but in some markets it does. So if you generate a capital gain from holding something over a longer period, that's going to be treated more favorably from a tax perspective than if you did it over a short period. And what your book does go into in a detailed way is how discounts on discount bonds get treated. So certain bonds trade at a discount. This, for example, includes zero coupon instruments. Zero coupon bonds promise to pay you something at the end of their life, their par value, and you typically buy them for a discounted price, a price below their par value, and you make a gain from the difference between the price at which you enter the purchase price and the par value, which is something written into the bond agreement, the bond terms. Now, how do we tax this difference? Because the bond doesn't generate any interest, any coupons. It only kind of gives you access to that gain from the discount. And there is a very specific way of treating this gain, which is US specific or specific to US investors. So what they do in the book is they say, well, you can calculate something called the OID. This stands for original issue discount. And this is basically the difference between the par value of the bond and its issue price, how much the bond was originally bought for. And in the US, at least, you have to know this, right? Even if you're not in the US. What happens is you get an OID tax provision, assuming you're eligible as an investor to qualify for this tax provision. And instead of paying a one-time tax on the maturity date, when you finally recover the par value and we say, oh, this bond generated a certain capital gain for us, and you pay tax on that, with the OID provision, the whole gain is, or the whole discount is proportionally recognized over time. So the idea is to recognize the discount on a sort of pro rata basis, so proportionately over the life of the bond. And treated as taxable income over time and subjected to income tax in the individual years of its existence. If you do not qualify for this provision, without this provision, you simply treat the whole difference between par value and issue price as a capital gain on the maturity date, and you pay tax then. Treat the discount as a capital gain on maturity. So the difference is, do you spread this gain over time and tax it over time in little bits proportionately to the flow of time, or do you treat it as a one-time income, a capital gain, which is subject to taxation on the date of maturity? And there may be differences also in the tax rate, right? Applied. And this something similar happens with premiums. Similar concept for premiums. You can buy a bond sometimes for a premium price relative to its par value. And once again, the question is, how do you treat that? You paid a higher price for the bond than the price at which you're going to have the bond redeemed. Obviously, in the meantime, you also receive coupons, which are taxable income. But how is this loss going to be treated? And under, the US sort of rules, that may be treated on a pro rata basis as a loss that happens over time, or as a one-time loss on the maturity date, if capital loss in other cases.